Hey, welcome back to another session of the Growth and Scaling Sessions. We've got some amazing guests in the green room, standing by, waiting to talk to all of you.
In today's world, there's more and more opportunity to have a hybrid in between both of those.
Your job isn't to get into the industry to get rich. Your job is to get into the industry to support and provide the best service you can.
Listen, discover, explore. I mean, it's exactly what I tell the brands that we open retail stores for, right?
Hey, welcome back to another episode of the Growth and Scaling Roundtable. I'm your host, Todd Westra, and today I've got some amazing guests. Before I bring them in, I want to really emphasize the fact that today's episode is all about exit strategy. If this is something that's important to you, listen up. If you own a business, this should be important to you. So for all of you who are listening out there who haven't even thought about their exit strategy, who have just thought about how am I going to launch this business, you've got to start thinking of how you're going to exit this baby that you just created and figure out how it becomes an adult and it can operate without you so that this baby can now become something that generates revenue for you and your family, and you can live and grow and have a good time without that business in your life every single part of your day. So exit is so critically important. Today, I brought on two guests who are going to help us talk about this. And today, we're going to start by introducing Chip. Chip's got an amazing advisory group. Chip, tell us a little bit about who you are and what you do.
Todd, thanks so much for having me on. Happy to do so. And I also got to say, I just love these sessions that you do for no other reason that I didn't even know what we were going to talk about till 5 or 10 minutes in. And I think it creates such a wonderful organic opportunity for us just to have conversations in front of all the people who have joined us today. So thank you.
It is so fun. Yeah.
Yeah. So my name's Chip Royce. I've got a firm called Flywheel Advisors. I've got decades of experience at the intersection of B2B and the internet and technology. But for the past 10 years with Flywheel Advisors, I've worked with mid to late stage venture companies and lower to middle market PE companies to help them figure out what are those obstacles for their future growth, or figure out how to capitalize on the opportunities they have in front of them. I work as an advisor, as a consultant, and even a fractional chief revenue or chief operating officer.
Right. And for those of you that don't know, these types of advisors like Chip over on this side, they are fantastic at helping you develop increased revenue, which we're going to talk about today, for a stronger exit, which is so absolutely critical. Our next guest is so awesome because she is someone who is on the flip side of this. She's not only growing her own business, but is also looking to acquire. And what goes on in the mind of the acquirer as they look at people thinking about their exit strategy? Anastasia, will you give us a heads up? Who are you and what do you do?
Thanks so much, Todd, for having us with Chip. And I am the CEO and co-founder of Regrow Ag. We're a climate tech business helping decarbonize agriculture, make it more nature positive. It's a complex space, as you're hearing. So acquisition of IP and acqui-hiring is definitely part of our strategy. So would be delighted to talk today about how to think about the alignment and the key tips for founders from the acquisition perspective, both on as they grow their businesses, the buying side of acquiring smaller businesses, as well as hearing from Chip on how we should all think about those who might acquire us.
I love it. I love this trio today because I just feel like it's bringing so many different parts of the equation of exit strategy. And for those of you, like I mentioned in the intro, that haven't really given it a lot of thought to exit, you really should be thinking about this. In fact, for many of you thinking of how you're going to start your business, I would almost think of how are you going to exit your business will influence and impact the way you start your business and probably the way you grow your business in a much better way if you already know ahead of time how you're going to exit that thing. Thoughts on that? Am I totally off the mark, you guys?
No, you're right on.
Okay, good. It's good to get the validation. I feel good about myself now. So thank you. In today's topics, I think of 5 things that you need to consider when you're trying to consider how to exit. First of all, how much is enough? Like, people have this grand thought in their mind of Elon Musk and the valuation of, say, SpaceX or Tesla, and how it fluctuates every day between however many billion and whatever. There's so many things to consider, but how much is enough? What do you need to do in this exit, and what's realistic? Have a goal. Who's willing to buy? How will the business operate without you? Because that is a huge, huge thing to consider in exit. What is your multiple? Do you even know what that means? If not, listen up. We're going to talk about it. And how do you increase the value of that multiple? Let's start off with the first thing, you guys. How much is enough? Chip, what do you do? How do you help people understand this when they're considering an exit? And in your consulting model, how do you teach people? How do you walk people through this?
It's not easy. And I've been there. I've been a startup founder. I've been an early employee at venture-backed startups, and a few bootstraps. And I got to tell you, when things are going great, how much enough is never enough. And when things aren't going well, people just wish something. And it's sort of the reverse of investing. I think you need to understand. It's like the old Buffett adage, right? You buy when things are down, you sell when things are up. Let me answer your question directly, though. With the folks I speak with today, I really think that they need to level set and understand 2 things. And this will dovetail into a later question as well. But where do you want to get to, and write that on the wall, frame it.
Yeah.
And then secondly, build the company you want to become. So I'll start with the second one first. People tend to say, well, I'm just going to Band-Aid it together early on, but we'll fix it later.
Right.
And I'd love to get Anastasia's thought on this, but I tend to find that it's too expensive and too late to try to fix them. You don't have to go for perfect, but
Yeah.
you got to make it so it's good enough. For instance, if you're a software company, deploying on the cloud, you have to design your architecture right the first time, because you don't get an opportunity to rebuild and have your competitors sort of sit on the sideline while you do that.
What do you think about that, Anastasia?
I certainly, from an operator perspective, we're building a new category: measurement, reporting, and verification of greenhouse gases for a particular industry, agriculture, so food, apparel. And Chip mentioned build your architecture right the first time. I think it's very difficult to do for a new category where you're learning a lot. And I think
Right.
you should be constantly strategizing to pivot, evolve, and keep evolving with the business evolution. But I certainly agree with the perspective that you need to know your DNA and who you want to be when you grow up. If you don't have that North Star to align all stakeholders around internally, you actually will not be able to neither acquire businesses successfully nor sell your business successfully, because alignment is one of those top 4 pillars that we think about when we're thinking of any business transaction.
Totally. And I think, to your point, Anastasia, very well said there. Sometimes your industry isn't mature enough to really know what is enough to get for that, what you just built. I feel like, personally, a lot of people I talk to have a tendency to think, but I put so many years into growing this business. It means so much. It's got to be valuable. Nah, probably not. Probably not as much as you think. Sometimes it's the opposite, where it was all of a sudden you go to sell and you get way bigger offers than you thought. That is not the norm. That is not the norm. And for those of you thinking that's going to happen, don't think it's going to happen, and just be pleasantly surprised when it does. But for those of you that aren't, who are just trying to get their foot in the door thinking, how do I exit this thing? How much is enough? And I was at a conference recently where someone who he got on stage and said, how much is enough? And he went through some scenarios. If you exit for 10 million, what will that do for you if all you did is live on the interest? It's actually surprisingly how awesome a $10 million exit could be. We all dream of the multi-$100 million exits. Just doesn't happen every time. It can happen, but how much is enough? Kill that horse. Any other comments on that one?
I certainly agree with the sentiment of thinking about what you need in life and doing the numbers on it and having clarity around how much would really be meaningful depending on what you want to do next. Do you want to
I love
found a
it.
company? Do you want to start investing? Do you just want to have a more comfortable lifestyle, hence the living off the interest opportunity? I think
Right.
it's really worth thinking through those scenarios, high, low scenarios, medium scenarios to understand what type of exit, to Chip's point, you're driving towards.
I love it. I love it. Chip, next question is, who is willing to buy? This is something, and both of you are going to have some great comments on this, but Chip, when you're working with a client and they're like, well, who would want my company? Who would want their company?
You'll never know. I mean, you could say, "Oh, I wish, I'm in the auto space. I wish Tesla would buy me," or I'm in the
Right.
software space. I wish Google would buy me. Um, and and I think this is another interesting area. Lay the groundwork for your exit on day one. Now you'll say, "Well, what do you mean by that?" Right? I got to run a company.
Right.
What I found interesting over the years is that people will tend to buy a company they're familiar with. Sure, there are occasional things. Somebody's been in the business for 18 months. They've got a really unique technology. It's been customer validated, or it's got unique IP, and somebody will snap it up. That's
Right.
great, but it's not the norm.
No.
The norm is people saying, "Hey, look, I've done business with you for 5 years. I've competed against you for 5 years. I've seen you at trade shows. I know you're pretty stand up.
Right.
I know you built something of quality," and those tend to be the dynamic for how an acquisition ends up happening, again, 5 years earlier. And my last point,
I
this is
love
one of the
that.
reasons why I encourage people to do industry partnerships, even if they have a direct model,
Yeah.
is it helps facilitate these relationships, whether it's a co-marketing partner, a distribution partner, a potential licensee. They get to see under the hood just enough
Yeah.
that you lay the groundwork for a future acquisition.
I love it. I love it. Anastasia, thoughts? I love those comments, by the way.
Those are great comments. And to Chip's point, you have to build those relationships early if you see an alignment. So, for example, if you want someone to potentially acquire later, maybe invite them as an investor, see if there is a fit, see if they can come in earlier into the company if you are fundraising externally. So coming back to the framework that I'm using, it's called the FAIR framework. It was from a book, Exit Right. And FAIR stands for Fit, Alignment, Integration, Rationale. So we talked a little bit about alignment, whether you know what you're doing, board knows what you're doing, stakeholders, employees. I think the fit and the rationale really play into the who will potentially buy you. If you were to step into the shoes of the company on the other side of the table, is it super clear why adding this thing to your already complex business?
Yeah.
Grow your business, with future-proof it, fortify it against recession, give it more resilience, give it growth in a customer portfolio. Like, it has to be so clear. As someone who has done 2 acquisitions and also have gone through integration of those businesses, I can really say, like, if you don't see it and if there's sharp corners and sticky points, you will have to work through them, because all of it will need to fit together. And imagine a complexity of that being done by a much larger company. Like, the legal, the overhead is growing exponentially. So who will buy you? You could kind of envision that as, oh, they can be integrating us into their platform suite, and this could give more wallet share because we sell to the same customer. Like, that's the type of rationale you should be pursuing, and then developing the relationships with those folks would be extremely fruitful to validate the hypothesis early, not to wait until it just kind of happens. It doesn't happen.
I love it. That is such, both of you bring up such good points. And I think most people out there have this imagination in their head of like the acquisition being a Google or a Tesla or whoever. More often than not, it is someone that you know in your industry, sometimes in a neighboring industry, and they just want your market share. Or there's so many strategic ways to exit your business that you got to be thinking, what's the strategy for a potential buyer? And if you don't think about that, you're never going to see the potential buyers, right? I remember I started a business in my early 20s, and I had a partner in that business, and we both had this vision of who we were going to sell to from the start. And it was one of the few things that we did really right. And when we were economic downturn in 2010, 2009, we were like, okay, let's execute our exit strategy right now, before we're all the way drained. And it turned out that it was a stupid time to sell, but what ended up happening is I exited to my partner because he was like,
Oh.
I'm willing to sit in the pocket a little while. We kind of waited. We kind of missed the bubble that we should have sold in. I'm willing to take this off your hands if you're willing to sell it to me at X. I did it. And 3 years later, he exited to one of our key employees and did a seller finance. For him, that was perfect. And it was not the exit strategy we had intended, but it worked out well for both of us. And so you never know who that buyer might be. Could be your partner, could be your key employee, could be your biggest competitor. Thank you both for bringing up those comments. I loved how you kind of led into that. How will the business operate without you? Anastasia, when you're acquiring a business, how important is that?
Oh, I actually love that question, on both sides of the equation. I think of one of my North Stars as a CEO founder is to actually make myself redundant in the business, to build the systems, to build the teams, to build the structures so that business can persevere, because it's climate action. We have to have it succeed in some shape or form. And I believe Rigor can be part of that solution. So when I'm thinking about not being at the table, is because I also want to live a life. I don't want my life to only be the business. And I do think great businesses in later stage, Chip would certainly know a lot more about this, but we're hearing as a scale up now and being evaluated a lot more in our financials, not on the quality of our team as maybe a smaller business would be evaluated. So that's from the kind of buying side, from the selling side of the table. From the buying side, I would say when we look at businesses for acquisition, usually, and Chip can corroborate my point here, usually it's assumed that the leadership would probably not continue with the business, given the leadership of the acquiring side has a different perspective. We had one of the acquisitions was a merger, so we actually did bring part of the leadership team in.
Love it.
And from the headcount perspective, that business could operate without part of the leadership team very natively, because we did think through the integration strategy very strongly.
I love that. Thank you. Thank you for sharing that, because you just shared both sides of the equation, which is absolutely critical. Chip, what are your thoughts on how do you get to business to operate without you? I loved Anastasia's comment on redundancy.
Yeah. And I can say firsthand, I've done really well with that sometimes, and I've done it poorly and made myself, didn't fix the things necessarily so I could be redundant.
Right.
So, I mean, that's just a day-to-day management headache. Sometimes an acquirer is going to be a bit more forgiving and say, look, we get it. That's why we're going to have an interim phase, and we've got some great integration people, and, we can help you. But Anastasia used the S word in there, which I thought was really strong. And that is systems, right?
Yes.
A business can't scale unless we get the systems in there that allow you to take a day off. They allow your phone to break. And allow folks to know what to do, what they're accountable for, and how to get stuff done without you having to walk them through it. Now, if you've built the systems and people aren't using them, that's a different thing. That's a cultural or staffing problem, and absolutely you got to go fix those. Because if you don't, you are delaying. You're basically using up capital and delaying the ability to have the exits we're talking about.
I love that. I love that so much. And honestly, for those of you who are considering the exit, if it doesn't operate without you, your likelihood of, or even the perceived value of it operating without you, the likelihood of you finding a good buyer is very, very minimal. Nobody wants to buy an employee. They want to buy a team, a system that operates without the founder always having to be the center part. And I love Chip, even the name of Chip's company, Flywheel Advisors. Like, you can't be that central hub all the time if you plan to exit your business. So, Chip?
Let's just talk about founder-led sales.
And
by the way, this is not just your local manufacturing company or landscaping company. So many ventures either have the technical founder still in the CEO seat, or the big revenue founder and sales leader in the CEO seat. And sometimes they resist letting go, especially when they do large sort of enterprise-styled relationship-driven sales.
Right.
If you're the lead salesperson every time, or you're required to be there to close a deal, why would an acquirer let you out the door?
Right.
right? By definition, you're probably suggesting, or you just don't even have the negotiating leverage to try to disprove that there should be a 20 or 30% haircut on the deal because they worry that without you, the revenues will miss the mark for some period of time until they can figure out what that formula is.
And that totally happens, which it leads to our next thing is, what is your multiple? Anastasia, when you're looking at companies to acquire, this is such an interesting game because most people don't think about it from that perspective. But what do you look at as a multiple? And what is a multiple, first of all? And what do you look at in creating how do you ideate in your own mind what is the value of that business?
I guess the basics first. Not everyone thinks about the word multiple as much as three of us do on a daily basis. So in the simple equation of some financial metric of the business, can be revenue, can be ARR, can be bookings, times this magical word multiple equals valuation. So effectively, you are optimizing for what the valuation would be by demonstrating how your business can drive the value into the future using the current base of the business and using maybe its position in the market, its brand, its maybe exclusive IP like we have. So when we are evaluating the multiple and we are evaluated on the multiple, those are the parameters that we're looking at. How non-negotiable is this advantage in the market that this business provides us? It can be something that can be built by us, but it is a lot faster to plug and play if it's the right price.
Yeah.
Is it a unique piece, like a unique piece of IP that will position us even in a more breakaway space in our category? In that case, maybe there's a higher multiple. If it's an acquisition, not just an IP asset sale, if it's an acquisition of a acqui-hire, if it's people, then how unique is that talent? How are they retained? What is their compensation structure? How willingly would they be operating and performing, thriving in a new company? Also is a big question. Because often when a business like ours is looking at acquisitions, we're not looking at putting a standalone pillar of something. We're looking truly at an integration. And those are the things that drive the multiple: quality of revenue, stickiness of customers, exclusivity of IP, the machine that you've built, the systems that Chip and I talked about, and the people.
I think that's a fantastic intro to what a multiple is. Chip, what is she leaving out here? What are we missing? And how do you determine a multiple?
No, I thought Anastasia nailed it. In fact, I wasn't sure we'd hit the IP, people, and product type aspects that I thought was the hidden jewel of all that, because especially if you're in the technology space, that can be a key part of it. But they also don't want a business that's going to be hemorrhaging money. So if you look at it, those three aspects, right? There's the intrinsic value. There's the top line revenue, right, as a multiple of how much you're selling. So if you're selling $5 million a year, an acquirer might pay 4 to 10 times that. But that doesn't necessarily mean you're making money. Now, in the venture world, when you've got the go growth kind of perspective, that might be okay. And of course, I'm sure there's differing opinions about the health of the economy today.
Yeah.
But I can tell you, and I'm citing a local investor here who's really well placed in the B2B SaaS world. His name's Tim McLaughlin with Co-Founders Capital. And he used a term that I've just latched onto, which is a durable business. You say, well, what's that? And ultimately what he was sort of getting at is in the venture world, we're going to give you money, just get really big. We'll sort out if you can be profitable later. His definition, and I'm just more aligned to these kind of businesses, they fit my DNA. The durable business is saying, okay, I might be growing, but I'm making sure that I'm at break even or profitable so I don't hemorrhage capital and I don't put myself in a bad position. So to bring this home, a company that's making money is actually really attractive right now. Right. If there's still capital out there looking for a place to go, if Anastasia hypothetically wants to buy something to enrich her business, somebody who's making money and is contributing in other areas can be really, really valuable because it's throwing off free cash flow and minimizes the need to go out and either take on debt or find an investor to make an equity investment.
Thank you. Well said. Like, this is really, really a great discussion. I don't even have a lot to add to that because I think that, when people think about their multiple, and this is kind of fun for all three of us, I think, because we all are in circles with other founders and people talk about, what multiple they're trying to hit or whatever. it is funny because a lot of people in their heads will always jump to that 10x or 12x, or maybe if I'm a unicorn, I get a 15x multiple or something crazy like that. The reality is most people should be really happy with a 3x unless they've got something fantastically amazing with recurring revenue that just continues to come pouring in every month. It's not realistic to give yourself, it kind of jumps back to the first question, how much is enough? Stop telling yourself that you're not going to be happy with less than a 10x multiple, because the reality is you got to be something pretty special to be a 10 plus X multiple. A good business doing good revenue should be really happy with a 3 to 5x, right? Am I off on that? What do you guys think of that?
Well, and let me throw it to Anastasia. How many times have you seen a company that would have said 2 days ago, if I could get this, I'd be so blip and happy. And then all of a sudden somebody knocks on the door. They might not even know who they are. It
Right.
may not be a massive company. And then all of a sudden they're like, oh, someone's coming. No, it's not this. It's
10x.
Yes, that's certainly the trend. And I think the macroeconomy is currently in a state where, as Chip mentioned, cash is queen. And it's important to optimize the business if you are looking at a short-term, near-term need to kind of get it off your hands. Like that's where the business owners are going. There's
Right.
still categories that are growing and are able to pull in capital. But certainly burn is a huge consideration for investors that
Oh man.
are on the market.
Yeah. Burn, recurring revenue, the lifetime value of your customers, are they a one-time buyer? Are they an every month, every year, every 2-year buyer? Like, what does that actually look like? And how much is client acquisition cost? There's a lot of other factors that come into play here than just top line revenue.
Todd,
am I right?
One other thing that I would mention is that if the acquisition is for kind of like a merger integration into another
Right.
business, that has a cost on its own. So the acquiring side usually is evaluating not only the asset and the quality of the asset, maybe to be attractive, you needed to have built exactly what they wanted, because there's still a huge integration cost and a slowdown to their core business, shipping, executing, because of the distraction that currently really costs. And that distraction can be heavily buffered if the business is producing revenue, because in that case, the integration is not as urgent. You can take time and figure it out better.
I love it. I love it. And for those of you that are watching this discussion, don't hesitate to throw in the comments your comments. Everyone's got opinions on growth and everyone's got opinions on exit. I would love to know what you think are the 5 most critical things. Are we in line with this? Does this make sense? And I'd also like to know, of the people listening, who's had a good exit, who's been a 10x, who's been happy with a 3x. These kind of things are so intriguing to me, because I really feel like, for me and my first exit, I'll call that business my first exit. Looking back, I was an idiot in a lot of ways, but at the time it felt right, because I wanted to move into something different, and it wasn't a very exciting business during the economic slowdown. So I was like, man, I just want to do something else. And if I get anything out of it, I'll take it right now. And that's kind of what I did. But looking back on it, I was kind of an idiot. So love to know in the comments, are you the idiot like me, or are you much smarter and had wonderful, amazing exits? I'd love to know about it. I think the rest of us would like to know about it. So Anastasia, while you're in the hot seat, what will increase the multiple? Like, what kind of things will take someone from a 3x to a 7?
Quality of revenue and demonstrated execution is certainly something we're looking for, and that we are hearing from later stage investors ourselves.
Quality of revenue. Explain that.
Meaning that maybe more recurring product core revenue rather than services that are people dependent or one-off projects, pilots. That's the quality of revenue, something that you can turn the product on, support it, and the business will keep going. That's the type of business that someone would want to operate without you, the founder, being in the seat.
I love it. Fantastic. Chip, what are your thoughts on how to increase that multiple?
I think great points by Anastasia. I think the only thing I can bolt on there is Also, how can you be demonstrating that you're seeing both revenue and margin improvement, right? If you can paint a picture of trend lines, that are going up, this can be incredibly beneficial.
Yeah.
For instance, I just finished a consulting project with a really neat private equity-backed company, and their margins needed to be better for their PE owners to get an exit. And what was really intriguing was we were able to find a neat way and a new distribution channels for them that took them from a quarter to 1% of revenue margins to 5 to 12%, just by shifting their current sales to these new channels, which were really easy to get. And that was such a boon to their investors, because now all of a sudden, especially in the markets they're in, in the mid-market private equity, it creates a much bigger market, and valuations for them.
I love it. The simplest example that I think most people can relate to is a dentist office. Growing up, I'd go to the dentist, and if I had a cavity, they made more money. If I didn't, they didn't make as much money. So what did they do? The smart dentist started thinking, okay, I'm going to build a family plan. This sounds so friendly for the family, right? Well, now the family is paying a family plan every 6 months that renews. It's a recurring revenue model for the dentist. Come and get a free checkup. It makes sense, right? Get a discount on some cavities. Makes sense. But they always have that recurring revenue every 6 months from me. It's a great strategy for dentists. And I have to say that in talking to the dentists I know who have implemented that, it has increased the valuation. It literally increased their multiple of selling their dental business, because why? They've got a consistent every 6 months recurring revenue piece. Whether I come in for a cleaning or not, it's recurring. It's hitting. It's up to me to come in and get my 2 checkups every 6 months, right? So that's a beautiful thing. Like, that's one of the simplest examples I've used for people who are like, well, how can I build a recurring revenue model out of a service industry? Look at your dentist, right? It's a great thought. Hey, any thoughts on that, you two?
I think it makes sense in terms of how can you provide value and get more cash flow predictability for your business.
Yeah.
And delivering both means that the customer is more likely to actually see that as valuable and transition to it. I think if it doesn't fit as naturally, it'll be much harder to bolt it on. Whilst I think in our minds, we're thinking, hey, well, I have to do those checkups anyway because I want to stay healthy. And that is preventative medicine. That's
totally
what you do.
It really is a good marriage, isn't it? It's a good value on both sides of the equation. One of the things that I want to throw in there, Anastasia, is that as people like you are looking to acquire, I think that, and Chip, you can probably add to this too, from a PE perspective and the clients you're working with, when they see a potential recurring revenue model that the owner or founder is not implementing right now, and they see that it would be easy to add one in, that is attractive to them, right? Like I've talked to a few people, just sticking with the dental office thing for a minute, who have acquired multiple dental offices because they know how easy it is to implement a recurring revenue piece like that. Yeah. That all they need to do is buy a decently operated dental office, plug in some recurring revenue model, and now all of a sudden that's a cash cow. It just keeps churning out money no matter how busy that dentist is. So Chip, thoughts on that?
No, I mean, look, that's great, right? It fits a customer need. Maybe to come full circle, and I might have mentioned this earlier at a lighter level, and Anastasia touched on it briefly. It is about creating value, though, right? So we've talked a little bit about it, sort of the greed factors and the I want to sell my business. I want to get out. I want to be rich. Right. I want to be able to sit in the Caribbean. Of course we do. Right. And if you build a great company, you should be able to, at the right time, be able to find that opportunity. Just a key point, though, is just because you built what you think is a great product and people should want it, doesn't mean there's an entitlement there either, though.
No.
And I think that entitlement sort of mentality can erode your ability to execute a great business.
Thank you.
I'm of the opinion. Sorry, I don't mean to get on a soapbox here, but you need to think, and it's not just on the shoulders of sales and marketing. It's across everybody in your company to think about how can you deliver an incredible experience for that customer, whether it's a consumer in a dental office, whether it's the macro environmental aspects of ag and sustainability, or a B2B service that caters to other companies. If you can delight customers, not only in the sales and marketing process, but when you deliver the product, when you provide technical support, when you come back for that software renewal, that's where you've really created the value.
I love it.
And in turn, that's going to be your multiple. It's
your
usually
multiple.
Not from saying, I built this really cool thing. It's time to exit. You owe me the money.
Well, I think this has been a very fruitful conversation. For those of you that joined late, the 5 topics we hit in this conversation: how much is enough? Who's willing to buy? How will the business operate without you? What is your multiple? And what will increase the multiple? Anastasia, I'd love your closing thoughts on this, and then we'll give a last little blip to Chip, and and then we'll wrap this thing up. Anastasia, what are your thoughts on exit?
Plan early. It has to make sense from the fit, alignment, rationale, and integration strategy perspective. That FAIR framework of the Exit Right book.
Right.
Check it out. Start thinking about it early. It just has to make sense. You can't kind of like convince someone to acquire business unless it's a good business and it fits them right.
I love that. Thank you. That's great advice. Chip, last minute thoughts here.
Just build a durable business. If you create value for the customer, it will create value for potential acquirers, and you've done the right thing and you haven't overthought it.
Love it. I think that's honestly fantastic advice. I would say to that, just in closing, for those of you listening who are trying to consider what the exit could be for their business, you really should be thinking about it right now. There is never a too early time to be thinking about your exit. And to both of these people's points, I don't know, I get my arrows wrong all the time. I'm not the Brady Bunch, okay? The most important thing to think about is that at some point you will exit. Like, you have to. Either you kill the business, you hand it off to a son or daughter, you sell it to a partner, you sell it to a PE firm, you have a strategic buyer that wants to build and grow in the territory that you're in. There are so many reasons. It's almost infinite. And it may not be the reason you thought you'd exit for that you exited. But I promise you this, for those of you who haven't considered it, talk to somebody. Talk to a guy like Chip. Talk to someone like Anastasia who's been buying companies and understand what they are looking for. I know that for me, and the reason that I sponsor conversations like this, I have an organization called Captain's Council that helps me a ton because I talk to other founders. I talk to other active CEOs and founders and say, what are you doing for your exit strategy? I literally was at a lunch with a group of CEOs 2 months ago, and the whole conversation was, how are you going to support your family when you exit the company? And that we spent an hour and a half talking about it. And out of the 12 people that were in that circle, all 12 CEOs had a different response. Were any of them wrong? No. But be thinking of exit, understand what you're doing, understand that building a business is hard, but it's rewarding when you get an exit that you're happy with. How much is enough? Who's willing to buy? Be thinking of the strategic partners to play with. Give yourself a realistic expectation of what to get out of the business, and you're going to be happy with it. You guys, thank you so much for being part of this conversation with me today. I loved it. I've given their information multiple times during the conversation. Feel free to jump in. Whoa, Anastasia's got the fireworks going off. And I hope that you gain some value out of this. Please leave comments below, and don't hesitate to jump on LinkedIn and connect with Anastasia or Chip. To be honest, both of them have amazing business models. That's the reason I invited them to be here with me today. I respect the heck out of both of them, and you should discover more about them as well. So thank you so much, guys, for being here, and we'll catch you all on the next episode. Thanks.
Thank you.